Markets have been off to the races today because PPI is showing deflation on a pretty big scale. For those of you that are unaware, PPI stands for Producer Price Index. It's the inflation side of producing products. So think about businesses, think about that taco you ate last night, think about that basketball that you might buy today because it's like 82 degrees in Michigan and it's going back to 30 degrees next week. So you might as well take advantage of that, right? That is an example of the producer side of inflation. You were expecting a 0% month over month change. It came in at negative 0.5%. Negative 0.5% times 12, you're over 5% deflation on an annualized basis if this pace were to hold up. So that's a good thing, right? Definitely a good thing. Inflation going down. Number one, that's bullish. Why is it going down? Now, we need to get that question answered because there's two ways that really inflation could be falling this quickly. Number one, it's the Fed's, policies are working and producers, consumers starting to expect less inflation, and you're actually starting to get less inflation. Number two, it could be because consumers are slowing down a lot faster than expectations. And these go hand in hand, but they're quite different. If consumers are slowing down aggressively, and that's why you're seeing inflation falling, that's not a good thing. But on the other hand, we're going to get bank earnings coming out tomorrow as well. And that could throw a wrench in a lot of this information. So we're kind of in this video going to look at the potential outcomes of the data tomorrow and how the markets could feel to all of these things, because today is a pretty aggressive rally. Is this the start of a rally higher after the last 2 days that we've seen those end of the day aggressive sell-offs? Well, we'll get into it. We'll also look at what has happened today with AMC Stock and give you guys some of the final numbers. So without any further holdups, hit the like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. If you guys also want to come trade with me live in real time, link for that down below in the description of this video as well. So number one, we kind of just went over the baseline, right? With PPI and CPI coming in lower than expectations, core did reaccelerate, and that's a key to this because the Fed will not pivot. They will not cut rates. They're not going to stop hiking rates until core really starts to come down as well. Until core is probably 4.5% is what I would imagine based off of what we've heard from the Fed thus far. I mean, they're willing to sacrifice a recession to get inflation down. And that's the number one question is inflation going down because we're going into a recession, because consumers are slowing down dramatically? If the answer is yes there, that's not a good thing, because right now the markets are pricing Fed rate cuts. There's a valuation here that is only sustainable with Fed rate cuts, number one, but number two, inflation or earnings coming in line with current expectations. Earnings estimates have fallen about 6% in the last month, but you're still expecting roughly the same earnings as we had in 2021. You're expecting about $220 on the S&P 500 for earnings, and that's at an 18.5 times multiple. That's expensive, and a lot of people would call this market, specifically technology, in a bubble. Now, why is tomorrow going to be so important, and why am I basically giving you guys a massive heads up? Well, it's because you're going to get retail sales, and that's going to be big because you're expecting retail sales to again be negative month over month. The February number was negative 0.4%. You're expecting the March number on a month over month basis to be negative 0.9%. If these numbers come in this negative, or potentially even more negative than that, maybe we get a 2% negative retail sales number, that's not good, because that's going to hurt company earnings, and that's going to hurt the valuation just disconnect we have in this market, because valuations are disconnected from reality and from what's going on in the underlying economy. So if you get bad data here, it's going to be bad for the markets. Now, like I said just a couple of minutes ago, you also get bank earnings, and some pretty big ones. So let's look at those bank earnings. That's Adam Aaron. We don't need him right now. We got JP Morgan, United Health Group, not going to really be important for the markets. Citi, Wells Fargo, PNC, and BlackRock that report tomorrow morning. Now, what's interesting about the banks, right, is what has happened over the last couple of weeks since the banking crisis. Investors, they started to buy your Apples, your Microsofts, your Nvidias, your Facebook, these large companies, because they are somewhat insulated to the fact they don't need to raise capital. They're profitable, right? So they're kind of insulated there compared to kind of the vast majority of companies. But what is interesting is the markets since the banking crisis have been basically saying the Fed is not going to be able to go as aggressively because of this banking crisis, because this is straining or will strain the economy. And while that might be true, what we hear tomorrow from the banks is probably going to sound a lot different than that. The banks are probably not going to come out and say things are terrible in the banking sector, right? That's kind of what the markets need to hear right now, because the bond market has been so busy pricing in rate cuts that the Fed will not be able to keep rates higher for longer because of this banking crisis. If there is no banking crisis, then there's no reason why the Fed would need to cut rates. If banks are fine, then who cares? I mean, let the little guys fail. The banks are okay, right? That's the overarching logic in the economy today, right? In government today. Let them fail. Let the little guys fail. As long as the banks are okay, we're fine. After all, the Fed wants to see millions of people become unemployed to get to maximum employment and stable prices. That's their dual mandate. So it's an interesting dynamic here. In a weird way, your best case scenario would be bad numbers from the banks, but decent guidance, saying things aren't great, things aren't, too terrible, but we still posted some good numbers. That's your best case scenario. It's hard to forecast what these numbers are going to be for these banks. A lot of analysts have lowered expectations, so expectations are pretty low. And based off what we've heard from Jamie Dimon, the CEO of JP Morgan for like 25 years now, he really said there is no banking crisis. Deposits are fine. People aren't leaving. There's nothing to see over here, dude. So with these two data points, it's going to be huge for the markets tomorrow. Then, coming in around 10 o'clock in the morning, should be right on 10 o'clock in the morning, there's usually like a 30-second delay, you're going to get the Michigan Consumer Sentiment Survey. Now, this is, as it says, a survey on the sentiment of consumers, and that's pretty big because this is a long-running survey. It's been going for like 65, 70 years now, and typically when you see consumer sentiment plummet like we kind of have recently, and what we have seen over the last 2 or 3 years now, you tend to get recessions off of that. Now, you also, in this survey, get inflation expectations, and both of those things will be important. Now, when you add all of this together, what's really going to drive the markets likely tomorrow is the bond yields. And that's why today I think most of this is actually a fake out, and I think it is the market makers that are actually buying stocks today and kind of selling them to you. Because if you look at the bond market, bond yields are actually up 0.3%. Now, why this is telling is because when bond yields go higher, obviously the cost of capital becomes more expensive, and that's a big reason why markets have been rallying. And this is essentially when we say the bond market is pricing in rate cuts, it's because the bond yields, the curve of the bond yield, is pricing in those rate cuts. So if yields go up, that means you might expect less rate cuts. If yields go down, you're going to expect more rate cuts. And that's exactly why yields have, went from 4.25 to 3.25, dropped 100 basis points since the beginning of 2023. It's expecting those rate cuts. Now, if the banks come out and say everything's okay and retail sales are decent, even if they are negative, if they're decent, then bond yields, investors, I should say, are probably going to go out and sell the 2-year bonds. And that's going to drive these yields up, which is going to dictate how the markets are feeling about future Fed policy. Hopefully that made some sense to you guys. It's kind of like a dividend stock. The higher bond prices go, the lower the yields go. When the lower the price goes of bonds, the higher the yield goes. So when investors sell bonds, it makes the yield go up. When they buy bonds, it makes the yield go down. Think about it like a dividend stock. So depending on how this data comes out and earnings come out, it's going to affect the bond market, and that's going to be the big story. Bond market is positive today, so they're kind of more or less expecting what I said, things to be okay, and the Fed not really have this weight on their back that the banks are failing. And ultimately, that's the reason why the markets are higher right now. Earnings estimates have been falling over the past month. It all comes down, literally all comes down to the Fed, and that is what has caused this rally. Earnings outlooks have not gotten better. The odds of a recession or avoiding a recession have not gotten better. Nothing has gotten better. Some would say inflation's starting to come down, and I would agree with that, but not where the Fed wants it to come down or needs it to come down. In core, that's going higher actually, and is higher than headline CPI. So maybe all of that was just fuel and energy, because that's what headline is for the most part. So hopefully you guys can paint the picture by now. Tomorrow is going to be vitally important to our markets. Not to mention, it is a Friday. And if there's any good time to sell stocks, it's usually on a Friday. Black Monday, Black Tuesday, that happened in 1987 that sparked a recession, where the stock market crashed 20% in a single day. The whole reason why you have trading halts, if markets drop 7% and then 10% and then 20%, they literally close the whole stock market, is because of Black Monday and Black Tuesday. It happened on a Friday, right? The start of it happened on a Friday, and then it really got bad on Monday, because investors don't like to hold over the weekends and during times of uncertainty. So that's kind of the warning I have for you guys. Obviously, nothing is set in stone. I don't know how these things are going to evolve, but there's a very clear bullish case here and a very clear bearish case here. I have to lean towards the bearish case after you have rallied about 1.5% literally across the board, and you've already rallied 7%, not to mention today's rally just since, this like 2 months ago. That's far too aggressive, far too quickly, considering earnings estimates are going down. Now, let's talk about AMC here briefly in this video as well. But before we do that, let's talk about some of these option trades that we are seeing coming through today with institutional investors. Now, I should point out that usually, as of lately, when the markets are rallying, the positive order value on any given day is usually like 65 to 85%. Today, it's only 48%. So even though you're up a lot today, over 50% of the option activity today has been bearish, and some of these bearish plays are super far out the money. A lot of them are targeting that May 19th to May 26th option expiration, and there has been a lot of trades today. So you could see one right here worth $100,000, a June 16th 360 put. There's a couple for like millions of dollars a piece, and if you were going to buy some of these trades, I mean, today makes sense. Here's this trade expiring May 26th, a 345 put on the S&P 500 for 1.5 million, a May 26th expiration 330 put for $500,000, and a May 26th 360 put for $1.24 million dollars. And you continue to look down, see another May 19th 365 put for 1.2 million. Another trade the exact same for 420,000. Another 350 put for May 19th for $1.29 million. If you really look at some of these trades, they're pretty bearish on a day where it seems like most people should be bullish, at least from the market's reaction. So be careful. I think a lot of this is algorithmic, and I think if tomorrow, if bond yields or any of the other things are a sign for tomorrow, it's not looking so pretty. Now, obviously, I've been wrong before. I could be wrong again. We are trading at 413 on the S&P, so it's not like we're at like 400 and there's actually room to rally from here. You've probably hit that cap here today, at least for this week. I don't really forecast hitting like 415 or 420. I would be pretty surprised. Now, AMC stock up about 2%. We only have about 6 minutes left of the trading day, roughly here. But I want to give you guys a brief rundown of the data that we're looking at here today. If you guys did not see the other videos, you're sitting at a $736 million total short position on AMC. That's the total value of these short positions. 26.69% short interest of free float. Free float out on loan at about 38.25%. 197.5 million shares that are currently out on loan. 5 days to cover with the cost to borrow rate of 261.25% and 100% share utilization. This is a 3-month average for the cost to borrow rates. So 3-month average, that's where all of essentially these arbitrage short positions have been put on. It looks pretty negative, right? If you took a short position out anytime in the last 3 months, you're down pretty big on that short position. Now, cost to borrow average over here on Ortex sitting at 378%, cost to borrow max at 516%, cost to borrow minimum at 345.43%. Cost to borrow numbers from Interactive Brokers. Again, Interactive Brokers favors institutional clients. Keep that in mind. So they tend to have lower rates than what you and me would pay. It's at about 400%. In between today, it's been about 465% to 400%. So in that overall range, about 250,000 shares that are currently available to be lent out. The option activity for the day in the positive order value is sitting at 16%, 57 orders, totaling $21.14 million. And like we reported in the last video, the last couple of videos now, every single green day we have had with AMC, you have seen the calls open interest number for April 28th become higher, now sitting at 19.45% compared to the open interest with puts at 80.55%. This is up from 9% at the start of this week. So you were ultra bearish for April 28th, and obviously why the court date's April 27th. At the start of this week, and now you're a little bit less bearish, but you're still very, very bearish on kind of AMC as a whole, right? And these are institutional investors, not necessarily retail investors, and that's why I think you're just so bearish. It's going to be really hard to get a sell-off after April 27th. I don't think it's, as clean cut as a lot of people want to think it is. Now, calls currently in the money at about 19,000. Let's go ahead and refresh this again. 19,000 calls in the money for tomorrow. 136,000 calls out of the money. 42,000 puts in the money, and 114,000 puts out of the money. So you do have a decent amount of option activity, although I really don't expect too much until we do get closer to April 27th, and then ultimately after that. Looks like we might close under that 100-day moving average as well, currently at $5.61 per share. AMC is at $5.44 per share. Not necessarily a good thing that we cannot close above the 100-day moving average over the last 2 days, but again, I think it's a positive thing. You're above the 50-day moving average and you're not falling when AMC has kind of had a negative beta recently. The markets go down, AMC goes up. Markets are up, AMC should be at least a little bit in the negative. After all, APE is outperforming compared to AMC, guys. So that is going to do it for this video. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Thank you guys for watching, and I will see you in the next one.